Hello and welcome to On Point, a podcast by Oak Street Funding, where we sit down with industry leaders and people like me to bring you insights into topics you want to hear about. I'm Rob Roach, Director of Underwriting here at Oak Street Funding, and I'll be your host today. Now let's get on point. Today I'm joined once again by Steve Blake. Steve is Managing Director at CBIZ, and we're going to be going deeper into our election coverage and different things that might come out of the election, whether it be topics from taxes to things that are going to affect our clients in the year ahead. So Steve, thanks for joining me today.
Yeah, thanks for having me, Rob.
To start off this episode, we're going to give a brief lending outlook into 2025. What that might look like, so that you can kind of prepare for, your business and setting things up. From what I'm hearing in 2025, we're seeing, again, banks have money, banks are looking to grow, but we're looking to do that cautiously. We're looking to do that, with solid deals, solid transactions, and really figuring out from a regulatory standpoint what changes are going to happen in this year, which I think everybody's trying to figure out.
Oh, absolutely.
Especially with the political changes that come back, and not only how that affects our clients on the corporate side, but also how that will affect them personally as guarantors and principals of our firms. And so, Steve, anything you want to add to kind of 2025 from a global point of view?
I would say, just from my perspective, working with those small business owners, I would expect to see an increase in lending in 2025. We've been seeing these decreases by the Fed over the last year or so in interest rates. And so once those start to hit the consumer side, that's obviously going to impact the customers of our clients and increase their business and allow them to possibly borrow more to help expand that business.
Absolutely agree. And, with the rate cuts in 2024 and kind of getting into 2025, being able, I think it's going to help our clients somewhat by increasing cash flows, by, increasing maybe the amount they can borrow a little bit more. But, mostly bringing some consistency, hopefully as we go into 2025 with what those rate cuts will look like and seeing where rates are going, especially from a yield curve, a more normal curve where our long-term rates should be higher than our short-term rates.
Right. And less volatility allows our clients to plan a little better and look more for the future rather than just the next 3 to 6 months.
Exactly. Kind of shifting gears a little bit, and leaning on your expertise as a tax guy, what tax changes are on the table with this new administration, and kind of what changes do you see, coming down the pike? One of the things I've been, kind of looking at and kind of hearing is, this administration might move very quickly on some things.
Yeah, that is absolutely true. So, with the Republicans taking control of the House, the Senate, and the presidency, we really do expect the tax bill to be introduced fairly quickly. Trump wants to hit the ground running, so there's already been a lot of negotiation taking place kind of behind the scenes. And there's been a lot of public statements by a lot of politicians on what they're looking for with a lot of these provisions. So, yeah, we're expecting, they always talk about that first 100 days of the administration. We're expecting one of the big bills during that first 100 days is going to be a tax bill. Now, there's still some negotiation going on whether or not that's going to be one tax bill that it kind of includes everything, or if they're going to try and break it up so they can get one passed fairly quickly that includes a lot of like the really key provisions, and then they'll kind of do the rest of it later. But we're hoping that within that first 100 days, we'll get a bill introduced, we'll get a better idea of what's going to be included, and then maybe by April or May is kind of what we're hoping for, to have something actually passed.
Right. Great. So I shouldn't file my taxes early. I should hold out and hope for the best.
Yeah, exactly. And part of that, too, is because with a lot of the things they're going to put into these bills, they're making some of this retroactive. Now, there was a bill that was passed in 2024 that had some of these same provisions, and that bill would have allowed you to run it through your 2023 tax returns rather than have to amend prior years. So for our clients, we are really recommending, yes, you want to extend your returns. Let's wait and see what's in this bill, and if they'll let you run a bunch of stuff through this year's tax returns instead of having to go back and amend.
If you would kind of go in, you mentioned some of these changes that maybe will go into effect, in this next 100 days. Kind of, if you would go into some of the detail, I know there's some of the tax cuts from the Tax Cuts and Job Acts of 2017, those type of things. What kind of things might be on the table for 2025 that, you're really waiting to kind of get a decision on and kind of see how to move forward with your clients?
Yeah, that's a great question. So we've got a lot of statements from a lot of politicians in terms of what they're looking for to be in these bills, whether or not they want it to be permanent or just an extension of what was in the Tax Cuts and Jobs Act. Because a lot of that Tax Cuts and Jobs Act from 17 is then slowly being phased out. Some of these provisions even fully expire at certain dates. And so a lot of what we've heard from the Republicans leading up to the election and then since the election is they really want to extend a lot of those Tax Cuts and Jobs Act provisions. So, for example, some of the things they're looking at extending, the Republicans refer to as the big three. Like this is their wish list. This is if we get the two bills that I talked about earlier, the main components of the first bill are going to be these three big things from the Republican standpoint. And it's going to relate to how a calculation is done for the interest deduction limitation. That changed a couple of years ago. And so they're looking to put it back to what it was before and extend that through the end of 2025, allowing you to deduct more of your interest expense, essentially. The other thing is bonus depreciation. We had bonus depreciation at 100% for a number of years. So as businesses buy fixed assets, they can deduct the full cost of those assets in the year they buy them, rather than deducting over a period of years. Well, that bonus has been slowly started to phase out. In 2023, I think it was 80% bonus instead of 100% bonus, and it was going to step down kind of 20% every year. Well, what this bill would probably do is extend that 100% through 2025, and then they've said maybe they'll do 20% of bonus for 2026, and then after that, there would be no bonus. So kind of extending out those provisions. And then the other part of the big three was the research and development expenses. So one of the things they've done, and you've always been able to get a tax credit for your research and development, but one of the changes a couple of years ago was the deductibility of your expenses for that research and development. You had to capitalize it and basically depreciate it over a number of years. So they're looking to go back and fix that for the last couple of years. And then again, through 2025, allow you to deduct those expenses in the year you incur them. And then so those are kind of the big three, but some of the other provisions that are really being hotly discussed right now, there's the SALT cap limit. So your state and local tax deductions is being limited to $10,000. Well, states that have high tax rates, they obviously want their people to be able to deduct a lot more than that. So they're talking about maybe increasing that to $20,000, $30,000, or just getting away with the cap altogether and allowing you to deduct the full amount. So there's still some negotiation going on with that one. They're looking at extending the tax rates. The tax rates under the current law, the decreased rates from the Tax Cuts and Jobs Act expire here at the end of 25. They're looking at extending that for at least a couple of years. And the other big thing is the unified exemption for estate and gift tax. So right now, at the end of 2025, that exemption drops back down to about $5 million. Right now, it's at about $13 million. So a husband and wife can pass on or gift about $26,000 tax-free, whereas if they wait until after 2026 or after under current law, it's going to be a combination of about $10,000. So they're looking at extending that exemption amount for a couple of more years as well to give people an opportunity to take advantage of that higher exemption.
Great. I think, one of the things that, we do a lot at Oak Street are acquisitions. And so, when we're talking about these type of changes, how these potential changes might affect that acquisition market, especially with an administration who I think appears to be very acquisition friendly. But, when we look at that landscape, what will that look like? And, I'll take a first stab at that. From my perspective is, we've always seen acquisitions coming through. When we talk about preparing your company to make an acquisition, one of the things that we'll always look at is, we look at what's your financial position now. And, one of the things that bankers and accountants sometimes, fight about a little bit is, a lot of CPAs, you're trying to limit your clients' taxable taxes and taxable income. And a lot of times as bankers, we're looking to, hey, we want your income to be as high as possible because that lets us, for underwriting standpoint, show you can pay your money back, and it works in the leverage and all these other type of things. And so, as I think about that, be prepared is, you're working with your advisor, working, with your tax strategy, making sure that, you understand as a business owner exactly what you're doing, so that when you're coming to somebody like Oak Street, for a loan, we want to understand, well, why did your income go down so far, the next year, when we're doing a comparison? Well, we changed our tax strategy, those type of things. So be prepared for that. But I think by changing bringing back some of these tax strategies, or or renewing them, for lack of a better term, not letting them sunset, I think should make acquisitions a little bit easier.
Yeah, I agree. I expect to see an increase in M&A market over the next couple of years as a result of the changes in the tax and the interest rates as well. You know, and part of that relates to the succession planning of the owners. So we're probably going to see some owners wanting to accelerate that succession plan to take advantage of these lower tax provisions now, rather than waiting a couple of years. Those provisions then expire and they're paying a higher tax bill as a result of waiting. So we're really looking to see an increase in our M&A market, just as a result of it being cheaper to sell your business, essentially.
Right. When, so if I'm a business owner right now and I'm seeing these things, I think it's very hard as a business owner that's not a tax expert to kind of figure this stuff out. So, when should they start that conversation with you all to say, hey, I don't exactly know maybe when I want to bring the next generation in. I don't really know when I want to, possibly sell my business. When should they start having those conversations with you?
Typically, what we like to see is at least a 3-year lead time, especially if you're going to sell to a third party. If you're selling internally to a key employee, a family member, not necessarily. I mean, maybe a year, 6 months even. But when you're selling to a third party, you really kind of want to have a 3-year lead time. And the reason is because of kind of what you mentioned earlier with the books and being able to show the income. Well, same thing when you're wanting to sell your business. You want to be able to show that level of income. And so what we want that 3-year lead time for a couple of reasons. One, we want to make sure we get as clean a set of books as possible that's really showing the true results of the business. But then also, most buyers are going to want a 3-year look back. So we want to have 3 years of those good, clean sets of books before you try to go to a third party to sell. You want to try and maximize what that book income looks like to really maximize your potential purchase price.
Sell high, right?
Exactly. Yes, exactly.
Perfect. Taxes and interest, are two factors considered when, we're calculating your cash flow, your EBITDA. Talk about how the potential tax implications, could have an impact on that, and especially when you're looking at that valuation for your business.
Yeah, definitely. So there are a number of different ways that businesses are evaluated when you're looking to make a sale. If you're looking at a multiple of EBITDA, taxes and interest rates aren't going to directly affect that because those are backed out when you calculate EBITDA. But part of those calculations always look at the results of your actual operations and your financial ratios. So like your working capital ratio and those types of things. And so paying less in taxes and paying less in interest increases your ratios. It really strengthens your balance sheet, and it'll allow you to negotiate more with the potential buyer to increase that value of your business.
And, we saw something, the exact opposite of that, last year when we saw rates increasing. You saw especially companies that were kind of having a harder time to begin with when those rates went up, kind of having the opposite effect where, all of a sudden we're having trouble showing the multiple and getting the multiple we wanted because earnings weren't there. I think that kind of comes into a question about, what could these anticipated tax changes mean for underwriting? And, I'll start with that one is, we base almost everything we do at Oak Street on your company's cash flow, and what that looks like. And we use all kind of fancy ratios, to determine, how much of a loan we feel or we're comfortable your company supporting. And, kind of like, you were talking about with the valuations, small changes that improve your cash flow, whether it's from, a lower interest expense or from tax changes. Maybe you don't have to distribute maybe as much as you did before to cover the taxes, increase that cash flow, which, a small tweak can make a big impact. So, that's kind of how, from our side, these things I feel that can affect, your company's ability to borrow money. Anything to add from that perspective?
No, I think that's right on point because a lot of lenders are going to be looking at those financial ratios, and you have certain amounts or percentages that you need to hit from an underwriting
Right.
perspective in order to be able to make those loans, or it might impact even the interest rate that the business is receiving. So I think, yes, having less interest expense, having less taxes, allowing you to keep that cash in the business to either utilize and grow the
Mhm.
business or at least strengthen your balance sheet definitely helps. And especially if we can show income within the
Mhm.
business, that always helps as well.
Yeah.
So I think once underwriting kind of looks at the whole big picture, obviously the less cash we're spending
Yeah.
on interest and taxes, like I said, it doesn't directly impact EBITDA, but it impacts all these other things that underwriting looks at.
Right. And, I think, and one thing to keep in mind, we look at first as an organization, we look at a firm's ability to repay debt. That's what we do. That's how we get paid back. But one of the things, to keep in mind is with these tax changes on the personal side, is also something we're going to look at. We do an evaluation of our guarantors, of our principals to see, what their ability is to support the debt as well. And so, as you're talking to your tax professional, I think it's important to understand, how those can help you personally, because our clients normally, they are the business.
Right.
It's
Right.
almost one and the same. It's the old one pocket to the next.
Right. Well, and they need to be making sure they're working with a CPA that's looking at things not only from a minimizing tax perspective, but from the whole picture, including the lending scenario. So, kind of like you mentioned earlier, from a tax perspective, we always want to get income as low as we possibly
Right.
can. But from a lending perspective, you want to get income as high as you can. So they need to be working with a CPA that's kind of looking at both of those factors and trying to come up with what is the right solution to solve both of those issues.
Right. And I think you just touched on my next point. If I'm a business owner right now and I'm hearing about these changes, they might come quick.
Mhm.
How can I protect myself, both in the personal and the corporate,
Mhm.
segments of, these changes coming up, and how can I minimize my tax liability, which, to me is really hard right now because there's so many unknowns.
Right, right. There really are. And like we talked about earlier, I think right now, because we know this tax bill is going to be coming, like I said, we're kind of expecting to see it in April or May. Well, the filing deadline is April 15th.
Right.
So let's extend returns if we don't get it quicker than that. And let's wait to see what's in those provisions. But then, even within that, depending upon what industry you're in, there are a lot of different tax strategies you can employ.
Mhm.
The tax code has gotten so complicated, and there's so many exemptions to exceptions to exemptions, and so you really need to be working with a CPA that really knows your specific industry and the tax code for your specific industry. So, just to give you a couple of examples, if you're working in an industry that has inventory, you need to be working with a CPA that can do LIFO as their method of accounting for inventory. If you have products that are leaving the United States, you need to work with somebody that understands the export incentives that are out there, such as an IC disc. There are a lot of these things that your tax professionals can bring to bear that'll lower your tax strategy even without this new tax bill.
And it's so complicated. That's why you're an attorney as well.
Exactly. Yes. Yep. I've got to be able to read the tax code and understand it.
That's right. Absolutely. One of the questions we had from our last webinar, we didn't have time to answer, talked about capital options. There are a lot of capital options, pros and cons for each one. What are the most important tax factors business owners should consider when evaluating those capital options?
So there's always a number of factors. So in addition to tax, I'll talk about in a minute. The first things we always look at, because we never want the tax tail to wag the dog, so to speak, we want to come up with what is the best overall option. So in addition to what are the tax implications and running projections and what does that not only look like this year, what does that look like for the next 3 years, 5 years, 10 years?
Right.
We want to look at, what is the cost of that capital? What's our ease of accessibility? So if we need to draw more on it, how easily can we do that? And then the flexibility of repayments. So are there terms that are in place that are going to penalize us depending upon our ability to repay? And so we want to look at all of those as a whole. When it comes to capital options, for the most part, they're from one to another, the tax is going to be very minimal in terms of the implications for that. If you're adding additional owners, obviously there's a tax implication there because you're spreading it across more people. Can you add some of those owners? Because there are limitations on who can own various types of businesses. So from a tax perspective, from an overall structure, from a capital, there's very little difference in terms of tax. So it's more a question of, is that something we can do based on the structure? And if we can, what's the cost? What's the accessibility, and what are the repayment terms?
Right. And, I think, from a banking perspective, from a lending perspective, one of the things is, and we say this a lot of times, but, the earlier we can have those discussions with you, the better. And, we can then get involved with, you as a client, you as a firm, working with your accountant to help, figure out what those best options are, and help us to understand, I think what your strategies, what your goals are. I think you'd mentioned before, having that, that path forward that you're going toward, that strategy, understanding that from a banking and lending perspective, I think is very important, because then it gets everybody kind of moving in the same direction.
Well, and that's a great point too. We always like to understand what are those short-term and long-term goals of our clients, even from a tax perspective, because I might put a strategy in place that if you're planning on selling the business in 2 or 3 years, that's something we definitely don't want to do. If you're planning on holding on to it for all, that's something we definitely do want to do. So we need to have those conversations up front as well and understand, what are your goals? What are you trying to accomplish? And then put a strategy in place to meet those goals.
Right. Steve, going off of that, when we talk about working capital, we talk about capital structure and that type of thing. When we talk about working capital, how much should a business maintain, and, how might that look different with the proposed tax changes?
Yeah, that's a good question. So, we've discussed a lot of these potential provisions. So your need for capital might be smaller over the next year or two, but then as some of these provisions, even what they're looking to extend, they'll sunset at some point. So at those points, you're going to need a higher working capital requirement. In terms of a dollar amount, it's kind of hard to say. It's really industry specific, but we've kind of talked about these ratios. You mentioned the working capital ratio. And there's the debt service coverage ratio. There's all these things that from an underwriting perspective, you look at. So really more looking at those percentages rather than a specific dollar amount, because it's going to change from one industry to the next. So when we talk about a working capital ratio, what we've seen a lot of times is the lenders are requiring that to be like 1.1 to 1.2. 1.2 maybe a little bit on the high side, but less than 1, definitely don't want to see less than 1. And anything higher than like a 2, well, you're obviously not utilizing your current assets effectively. You could be employing those to purchase longer term assets or pay down long-term debt, and strengthen your balance sheet, and also allow your business to grow. So it really kind of depends on what your ratios are, and trying to get your ratios in line for all these different things that underwriting would look at. Because that's, the reason you guys look at that tells you it's a healthy business and they're doing what they need to do. Kind of the same thing, what we're looking at is making sure that you're fitting within the right percentages and you're utilizing your current assets effectively.
Right. And great point. And, generally as a rule of thumb, in banking and lending, if a ratio starts with a 0 point something, it's usually not a good thing.
Right.
And so, but, to your point, when we look at that, for whether it's a current ratio or a quick ratio, whatever the case may be, it's really, do you have enough, incoming funds to meet your current obligations.
Right.
And so, that's something that's important for us to understand, especially as we put it into the global perspective of how it relates to, EBITDA, how it relates to debt service coverage, your leverage, the owner's ability to inject capital, all those things kind of come in together,
Right.
And play a role when we're making a decision there. So, to wrap things up and help our listeners, be a little proactive, what are 3 kind of takeaways, kind of strategies that a business could use in 2025 with tax changes in mind?
Yeah, so kind of related to the big 3 tax provisions we talked about earlier. Obviously, if you're in a business where there's any kind of research and development, if these provisions get extended, you're going to want to increase those expenses for research and development. That'll help your company long term. While also, from a tax perspective, you're getting a tax credit and a deduction of those expenses. So take advantage of these tax provisions now and do as much research and development now before those provisions expire. In terms of debt financing, like we've talked about a lot, if we get this increase in what you're allowed to deduct for your interest expense, not only are you paying a lower amount, but you're getting a tax deduction for it, which impacts the cost that we talked about of that borrowing. So making sure you're appropriately handling your debt financing in order to have that cash available to help grow and expand the business, maybe even fund some of this R&D, And then the other part of that, I mentioned the bonus depreciation, being able to deduct the cost of those fixed assets in the year that you purchase them. Well, if that provision goes into effect, you could look to expand your business again by doing the debt financing and look to expand your business by additional assets that could help grow your business. If you're a construction business, buy construction equipment. You're paying at a lower rate. You're going to need a tax deduction for it. Plus, you get to deduct the cost of the equipment in the first place. So,
Right.
all around, a huge benefit to you from a cash perspective that's allowing the company to grow. And you want to start that now rather than waiting until later.
Gotcha. Great. Well, I sure did learn a lot today, and I hope our listeners did as well. One question that I had, what's your biggest challenge when you're talking to your clients? And I'm thinking about, if I'm sitting there as a business owner right now and I'm wondering, wow, we've mentioned that these changes could come quick. These changes are probably coming one way or the other. What when should I adjust the tax strategy for my firm? And what do you hear? Why your clients? I'm reluctant to change because X, Y, Z, or that type of thing. And do you feel that? Do you see that from your clients?
We do. And I think a lot of it is just the volatility. I've talked kind of in some of our past discussions about how much change we've seen in the tax code over the last few years. So if you think about it, to put it in perspective, the Tax Cuts and Jobs Act came out in 2017.
Yeah.
The biggest tax bill prior to that was the revision of the tax code in 1986. I mean, it had been 30 years since we had a major tax bill. We've had 5 in the last 6 years. So the rate of change in the tax code is just tremendous. So there's a lot of volatility. People are reluctant to do things because they don't know what the future holds.
Right.
We know that if Trump comes in, we kind of have an idea what the next 4 years are going to look like. Well, what if the Democrats take over after that? Well, even in the last few years, because there was a change in the House in the middle of the Biden administration, the midterm elections changed things. So there was some volatility there as a result. So really just that nervousness of, well, what's the future going to look like? So I want to try and keep my cash as much as I can now, not buy fixed assets, not really look to expand the business. Well, we're never going to know what the future holds.
Yeah.
But expanding your business, if you're thinking about it from a tax perspective, taxes are always just a percentage of your income.
Mm-hmm.
So if we can grow your business and expand your business, you're going to pay more in taxes, but you're still netting more at the end of the day after taxes.
Right.
So really trying to get people to understand that, yes, there's a lot of volatility. Yes, you don't know what taxes are going to be, but that doesn't mean don't utilize your funds now. Let's do it strategically. So a lot of what we've been doing with our clients, because there is so much volatility, is, most of the time when you're looking at things from a tax perspective, you're looking at it from like right now, what year am I in and what do I want to do this year? What we've been trying to do more and more with our clients is do 3 or 5 year projections. We know what the tax code is now. So assuming no changes, here's what your tax liability would be. And you can do what if scenarios. What if I go spend this on this piece of equipment?
Right.
What if I go add this location to my business? Let's run the numbers and let's see what that looks like. And is that something you're willing to do based on those numbers? So really thinking about it, running projections and running numbers and doing the calculations to see what does this really look like, not just going from a gut instinct of, well, it's going to cost more in taxes, so I'm just not going to do it.
Right. Very good. Great points. And I think that's one of the things, we do as well. We like to encourage our clients to do projections, think about the future, be able then to manipulate those projections and put different assumptions in so that you can maximize your efforts. So,
yeah, absolutely.
Again, thank you all for listening to On Point, a podcast by Oak Street Funding. I'm Rob Roach, and tune in next time wherever you listen to podcasts as we get on point. Don't forget to follow us on Instagram, subscribe, and leave us a review, hopefully a good one. And we appreciate your time.